So, per usual, or at least it's the new normal, there's always big news in our industry. And Nayeli is going to share with you guys the latest headlines that have popped up for us.
Thank you. So, as a lot of you have heard, last week the official announcement was made to increase the confirming loan limit from 726,200 to $766,550. So the official announcement which was made, which is incredible. So that helps us have Washoe County be a lot more affordable and attainable for all of you buyers. But what exactly does that mean? So that means that you can afford a $790,000 house in Washoe County with just putting 3% down. That is, of course, if you're a first-time home buyer. So what exactly does 3% down on a $790,000 house look like? Well, that down payment would be $23,700, which is a lot more attainable and affordable. With the cost of living increasing in Washoe County, this increase in the conforming loan limit is very necessary in order for all of our buyers to be able to afford to live here. And before, if you were trying to buy a house and you tried to borrow more than the $726,200 conforming loan limit, then you were stepping into jumbo territory. A jumbo loan is more complex in regards to qualifications, interest rates, and the cash to close. Also, there's going to be a lot more challenges for you to overcome as a buyer regarding your finances, because pretty much your finances need to be pristine if you are entering that jumbo territory, just because a jumbo loan is not as forgiving or attainable, especially with you having a lot more negotiating power being on the buyer side. With a conforming loan, we are able to layer a lot more opportunities on top of one another so that you're really comfortable with your payment and your cash to close. For example, with a conforming loan limit, we're able to have you do like a 2-1 buy down, a 1-0 buy down, 3-2-1 buy down, and permanently buy down your interest rate. If you're getting a jumbo loan, we're not able to layer that, and you're not able to do a buy down scenario. So that's a con with jumbo. And then also with jumbo, you need to put a lot more money down. So you could put 10% down, but your interest rate is going to be astronomical. So really, we need you to put 20% down. A lot of times you're going to need reserves. So your cash to close is going to come up. So we're super excited about the conforming loan limit going up, because this is just going to open up a lot more opportunities for people to be able to afford in Washoe County, specifically with prices going up, especially as rates start to come down. But those are the big news that you're hearing about, and really, really great news so that you don't have to go into jumbo territory.
Yes. We like any good news we can get nowadays. So, we also want to share, what are the most pertinent market updates and the things that we're seeing change in real time. That's the beauty of this webinar, is we wanted to get together with you guys monthly to talk about what's changed in just the last few weeks so that you can keep a proper pulse on the market, whether you're a realtor, a lender in a different market, or a buyer who is looking to invest or buy your first home or your second home. We want you to have real-time information as it's changing, because it's changing really quick. So some of the things that we need to talk about this month to keep you in the know would be inflation. We need to talk about what's ahead for interest rates and whether it's going to be a smooth or bumpy road. And we need to talk about inventory. These are going to be the main factors to consider, not just for the last month of this year, but looking ahead into 2024. So inflation predictions. We've been trending in the right direction for a few months now, and it's been really amazing. It's what's driven interest rates to start to cool off instead of to continue climbing upwards. The next 2 months readings, though, those might get a little bit tricky for two reasons: health insurance and holiday spending. Holiday spending was forecasted to not be great this year. Retail expectations were low, and it was kind of putting a damper on the whole mood. The vibe was low. But then Black Friday came along and Cyber Monday, and I really don't understand how, but they blew out expectations. Spending on Black Friday and Cyber Monday from the consumer hit record highs, which is interesting. Like, I really honestly cannot explain this, because we know that consumer debt is at 1.1 trillion. We know that savings rates are down. So this tells us people are maxing out their credit cards. We're seeing credit card delinquencies rise, and they've spent the money, all the free money, all the stimulus money, all the extra money they had from 2020 and 2021, they've spent it. So where they got the money to go haywire with on Black Friday, I don't know. But it may not look great when we get our inflation readings for November. And then health insurance, I don't have to tell you guys probably have experienced it personally. That's a very safe assumption for me to make, that because health insurance is extortion. Like the costs that I'm assuming that you're experiencing are very high. And so we can only imagine if they're changing the way they're going to measure that now to be more accurate, that's not going to be great for a report that measures the cost of goods, right? Or services. It could be. I don't know. I don't have a crystal ball. But those two things could give us a little bit of cause for concern for the next 2 months inflation readings, that they may not continue to trend down. They might be bumpy. The other thing that might be bumpy is the road for interest rates. So I want to set the record straight that the Fed has not formally announced or guaranteed that we're going to have 6 interest rate cuts in 2024. It's really interesting how much the sentiment has changed, specifically in the Fed futures market over the last month. When Sandy Nayeli and I came home from a big mastermind event in San Francisco, it was very somber. And the mood within the industry was things are going to get really tough for our buyers and sellers before they get better. That 2024 was going to be another really rough year for real estate. And then all of a sudden now, just a few weeks later, it's really optimistic. We're feeling really good about this next year and how many families we're going to be able to help get into homes. And I'm all for that. I'm really here for the optimism. I personally needed it quite a bit. I just want to put a little pause on us popping the champagne bottles, because I see people saying that the Fed has announced rate cuts. They have not. They are actually saying the exact opposite because they don't want markets to get ahead of themselves. You cannot table your plans to buy a home hoping that you're going to have a better interest rate here in the next couple months. That would be a poor strategy. The cost of waiting is still high. Our team is happy to show you those numbers. And I'm not telling you that because I want you to buy now so that we can get paid now. I'm telling you that because if I've learned anything this year, it's that things don't go as expected. There's so many curveballs that get thrown, and we don't know for sure that they are going to cut interest rates. We see a lot of economic indicators that we are headed to a recession. The Fed has been really vocal that they would tackle inflation at all costs, right? They've also been really vocal that they want a soft landing. A soft landing means that they bring inflation into check without completely destroying the economy, without putting us into a massive recession. So the reason people are getting so confident that there's going to be rate cuts is because people are getting more confident that we are actually headed towards a recession. That's not great news overall, but for real estate, if we're headed towards a recession and the Fed is true to their word that they really want a soft landing, then they may cut interest rates to help re-stimulate the economy. They also really want to avoid deflation. So deflation does not just mean inflation coming down. Deflation would mean if inflation readings went negative. You might think you want the cost of goods and services to be less, but the problem is if big companies cannot make a profit on their goods because there's not enough demand for it and they have to keep the prices so low, when the guys up top start reading those reports, what they do is they start laying off people down here. If we're already in a recession and then that recession leads to deflation, which leads to more layoffs, you can see how this becomes a vicious cycle and the landing is anything but soft. So I do personally think there will be rate cuts in 2024. If you were here last December following my blog and my videos, then you know that I am often wrong. So don't bank on what I'm saying. Don't bank on what the influencers are telling you. Don't bank on anything. Just make your strategy in real time. Decide based on what interest rates are now. Decide based on what your numbers look like now. Decide when it's the right time to buy, when it's the right time for you personally and financially, and do not try to time the market. It's like trying to catch a falling knife and you will bleed. Now, moving on to inventory. As interest rates come down, that's amazing for your monthly payment. That's amazing for affordability. or it's helpful for affordability. I guess I shouldn't overshoot this. Home prices are still likely going to be higher than what we'd like for affordability. The downside of interest rates coming down is the competition. There's not more homes. We know we have an inventory problem. We actually have an inventory crisis. So as interest rates come down, every percent they come down, we could see somewhere between 1 million and 5 million buyers come back to the market because they qualify again. They've been priced back in. But there's not 5 million new homes for them to buy. So we'll be back in a bidding war situation and we'll see an acceleration of prices again. Great if you own your home, because an acceleration of pricing just means return on your investment, right? That's your home value going up. But if you're trying to buy, it's something to be aware of, that you don't want to wait until the media says that interest rates have hit their new bottom, because then everybody else is jumping in too and competing with you for the same number of homes. We think that these interest rate cuts could come because of everything I just went over with the recession and the economic indicators. Then if we want to go more conspiracy with it, we think that because we're heading into a election year, that the current administration is not going to want to go in to the polls, have you go into the polls feeling grumpy. They're going to want you going into the polls feeling good about life. And feeling good about life means that you have a good place to live. So they want the economy buzzing. They want people spending money. They want people to think that this pain we experienced in 2023 was a distant memory. They want it as far back in the hindsight as possible. And lucky for them, Americans tend to forget pretty quick. So they may do things that will drive up activity in the economy as a whole, but specifically in housing. Now, let's talk about you and what's right for you, and whether you should buy or whether you should rent. And we've done on this webinar, and you guys can always catch the recordings of previous months' webinars. It's not that things become irrelevant in a month. It's just that there's new news to share. So watching previous webinars would be really helpful. And the link is on my YouTube. You can find it and watch previous ones where we went into numbers about buying versus renting. But Sandy's going to talk about a different component to this whole thing.
Okay. Awesome. So I wanted to go over the psychological, the emotional, the health benefits of purchasing a home. There's a lot of talk in our industry of buy versus rent, right? And we know that there's a pretty substantial upside financially for investing in real estate. So, right, this ranges from, well, there's 4 main pillars. So that you can capitalize on purchasing a home as a financial investment. One, you're locking in your housing expense and protecting your budget from rent increases. This also allows you to prioritize budgeting in other goals because you know that this is a fixed expense, or you know what it's going to be, and you can put other important things in your life into your monthly spending. Um, on top of that, you're investing in an asset class that increases over time. So for reference, 32 over the last 32 years, the mountain zone, which is our area and kind of just a little bit east of California, Oregon, um, we've seen a 465% increase in home prices over the last 32 years. So when you think of like the average or the most common type of mortgage being 30 years, like over that time period, if you were expecting to hold your home over that time period, you can expect to see pretty good growth in the price of your property. You're also paying your loan down every month, which increases your equity. And then on top of that, there's some pretty sweet tax benefits, both when you file your tax returns annually, and then also when it comes time to sell for your move up home, there's a capital tax gain exemption that can be pretty awesome. Renting definitely has its place, and for some people it makes sense. There's a season for it, right? If you're planning to live in an area for a very short period of time, or you don't feel like you have job stability, or you can't qualify, or just aren't ready to commit to buying and maintaining a home just yet, or even if you're able to qualify but not in the area that you need for your family, there's definitely a place for renting. But what I really want to talk about today is the other benefits of purchasing a home in addition to the financial benefits. So you have increased privacy.
You have certainty, like I said, locking in your housing expense, and then having that like mental clarity of what you can expect. You have your protection against inflation because your home is going to get more expensive over time with the cost of other goods. And it can possibly even outpace inflation like we've seen over the last 32 years. Then you have the shelter and autonomy, right? Because your home is a roof over your head, but it's also like an emotional haven, like a safe place that you have control over, that you can keep how you like. You can remodel it or change your environment, and that is really freeing. And then there's the stability. So accounting for age, income, and marital status, homeowners are significantly less likely to change residence than renters. So that allows you to save on both the mental and financial costs of moving. Plus, you don't ever have to let your landlord in. Then there's also been proven health benefits. So homeowners are actually 2.5% more likely to have good health, both physically and mentally, and a greater life expectancy. Then you have future flexibility options. So investing in a home now opens up more options for you later because you can leverage that property to pull money out, pay off other debts, invest in a business, buy a new property. You could convert the one that you had into a rental or sell it and leverage that equity for a move up home. So there are just so many options that you have as a homeowner. One is extra income. Like you could rent a room on Airbnb or do what I'm doing and get a couple of roommates via like a house hack situation so that your monthly budget is even easier to deal with. And then there's actually also been studies that homeowners are more likely to vote because they have more of a vested interest in their community. They tend to stay for longer. So you're building community, you're meeting your neighbors, like it's just you can build more of a home. And then something I found really awesome when I was researching this is that homeowners actually experience better mental and physical health, reduced rates of divorce, and improved school performance and development of children, as well as increased financial and physical health for seniors. And so some of these stats were cited as coming from the stability of homeownership, but then also like certain skills that needed to be developed to become a homeowner and also like the responsibility of maintaining a home. So it was just really cool to see all these other benefits of homeownership in addition to the financial part, which we know and believe and like we talk about that a lot and we share that with our clients a lot, but then there's so many other like mental and physical benefits that I thought would be really cool to talk about as well. So just wanted to share that with everyone.
I think it's really cool too. And I think it's interesting. And especially for our realtors on this call, that's information that is helpful for if you don't want to explicitly share it with your client because you don't want to come across as like salesy or pushy. It's good for you to know, to understand why people want to buy what you sell and what it means to them beyond a roof over their head. That's huge. Um, so thanks, Sandy, and thanks for researching it so much. Okay, we're going to talk about how you should plan ahead. A lot of December is holidays and checking out a little bit and enjoying life, but a lot of December is also planning for the new year and what you want to accomplish and what you want to do. So Nayeli is going to jump back on and talk about your 2024 budgeting strategy.
Yes. So now is the time to really sit down and write your financial goals out for 2024 and look at what you were spending on this past year. Look through your bank statements, look through your credit card statements, get a good pattern of what your habit is of spending and also what your relationship with money is so that you can really come up with a budget that's going to work for you in 2024. Also, you want to do is look at what months you're going to have higher expenses versus months where you're going to be able to save a lot more money. For example, if you know that you have two destination weddings, you want to make sure that you budget for that separately than maybe if you're trying to purchase property in 2024. Also, with rates coming down, as we've talked about, there's going to be a lot more competition, which means you're going to have less negotiating power. So, with the people that we've been helping with now, they're able to negotiate interest rate incentives and getting all their closing costs paid for. So they're really only coming in with the minimum required. We're going to see a shift in that in the upcoming year, year and a half, with you needing to come in with all of your down payment and your closing costs. And if you don't have all of that money, you're going to have to start asking family members for gifts. Also, with that being said, now is the time to really just go after those promotions, go after that higher pay, and save as much as you can and start practice having that projected monthly housing payment. So, for example, if right now your rental is $2,500 a month and your projected monthly payment is going to be $3,200 a month, save that difference and put it into a high yield savings account so that your money starts making you even more money. And another topic that's really critical for you to just address is if you are going to be purchasing a property with a significant other that you're not married to, now is the time to have the talk. Have the money talk and just lay it all out on the table because it's a really uncomfortable, kind of scary, freaky conversation. I think that the money talk is kind of scarier than the marriage talk because it's like, ooh, here you go. Let me just expose myself to you. And so now is the time to have that conversation and make sure that your financial goals align. And if they don't, discuss why and see how you can overcome that. And lastly, don't go crazy with buying presents for Christmas. Your well wishes, your time, and your energy are more valuable to people than you know. But those are my tips for budgeting for 2024.
But okay, awesome. Next, we wanted to kind of go over co-signing. So lots of times when we're working on a loan application and working towards qualifying, we'll suggest getting a co-signer. And I hear people throw that out willy-nilly all the time. So I wanted to go over what's involved with co-signing, and kind of some of the myths about it. So when someone co-signs, they're essentially applying for the loan jointly with you. So this means that they will have ownership in your property, but also be liable for the mortgage that you're taking out. So it'll report on their credit report. If you don't make the payment, they need to, it's a joint responsibility that you're applying for. So the main purpose of co-signing is to show more income on the application and improve buying power. When we look at your application, what we're looking at is your debt to income ratio. So this means your total monthly liabilities. This includes everything from a car loan, student loans, personal loan, and also your new mortgage payment is going to be factored into this as well. And then we're comparing it to your total monthly income. And income can be anything from your primary job to other investments that you have, or even second jobs, sometimes even government assistance. So again, there's a lot of strategy here, and a lot of the reasons that some people can't qualify is because they just don't have the history of income that we need. So again, always something that you can, strategize with your mortgage advisor. But basically, when we're looking to get a cosigner, it's because we don't have the income we need to qualify. So by adding someone who has good income and low debts will improve your debt to income ratio, basically adding more wiggle room for a larger mortgage payment, which improves the amount of house that you can qualify to shop for. So one frequently asked myth that I hear all the time is, will adding a cosigner help? Will adding a cosigner with good credit help my interest rate? And the answer is no. So mortgages are calculated using the lowest credit score amongst all borrowers. And this makes sense when you think about it because mortgages are priced according to risk levels. So that includes things like what kind of down payment are you putting down, stuff like that. And when we think about your credit score, this is essentially viewed as like a GPA for your payment history. So it's used to determine your likelihood of paying this mortgage back. So that's just a big one I hear all the time. So let's talk about like the pros and cons to the cosigner, because then we're going to talk about how to actually talk to them about being a cosigner for you. So the benefits to them are that they're diversifying their credit and adding a new account to improve their payment history. They're also helping someone that they care about make an investment in real estate, and that can be really life-changing, we know. And then also in most cases, your cosigner will have an ownership in the property that you're buying. So that is another benefit and protection to them. And the cons for your cosigner are, like I mentioned before, they are liable for your mortgage in the event that you don't make the payments. So there needs to be a high level of trust in this kind of situation. Um, Additionally, it could be harder for your cosigner to qualify for their own mortgage in the future. So one key point to this is that if you're applying for a loan and you're getting a cosigner, let's say you buy a house, if you make the payment for 12 months after you buy the house with a bank account that only has your name on it and not your cosigner's name on it, there are ways that you can actually, your cosigner can actually exclude this mortgage from future applications, freeing up more of their buying power because we have a history of you making the payment and that not being a debt that they are responsible for, even though technically they are responsible for it. So that's something that can be important when you're, again, thinking about how to handle this to make sure it's mutually beneficial relationship for everyone. So when you're thinking about how to actually approach your parent or your aunt or uncle or friend to help you co-sign, I would just say be really well informed. Like we'll have a conversation together. Anyone on my team is happy to help you go over pros and cons of this or talk to your co-signer about it. But just tailor your approach to that specific person. But we recommend having a plan of what you're going to do with the property. You can show them some market data, explain why this is a good investment, and what you picture the co-signing relationship to look like. So a lot of people who buy with a cosigner are able to refinance and remove that cosigner within a few years as their reportable income increases or they get promotions or they have a longer self-employment history or a longer period of variable income that's averaged. So that's kind of just, again, we would just want to be strategic about how we approach it so that you guys can all make sure your goals are met. So the other thing is like, if you're not able to qualify for a reason, like let's say you're a waitress and you have tip income that you don't claim on your taxes, your cosigner can understand that and realize that you actually can make the payment because you have this other income. It's just not income that will qualify you for a mortgage. And the same thing could be said for if you're going to buy a house and have roommates live with you. Again, that's something that in some scenarios would not help you qualify for a mortgage, but would put your cosigner at ease knowing that you have other income coming in to make the payment that they're signing up for with you. So again, it's kind of like a business relationship. So we just recommend that you have open conversations about what it looks like, what the goals are, how long you're expecting them to be on the loan. And like I said, anyone on our team is happy to talk with you or your cosigner about what it looks like, how we can set both of you up for success and the pros and cons of any situation. But it can be an incredible way to help your family and invest in real estate, which like I said, we know is like a huge life-changing thing. So yeah, if you have questions, let us know.
Here's the thing about all three of us. We really don't like to waste money. So that's why we're so big on the total cost analysis and running the numbers on what's the best way to structure your offer. Should you ask the seller for a price reduction? Should you ask them for a temporary buy down, a permanent buy down? We are big on the numbers. And you've seen that if you've been at previous webinars where we dive into it and we show you how much difference numbers make. And then how they really do speak for themselves. Like, put opinion aside, this strategy saves you the most money on a monthly basis and over the next few months or few years. Well, one thing that we all want to keep in mind is that if these rate cuts do materialize in 2024, you actually at this point may not want to waste the seller funds on an interest rate buy down that's permanent or temporary. You may want to use those seller funds to make more repairs. You may want to reduce your cash to close as much as possible. You might want to use a seller credit to improve the home. How, you might be asking? Well, if the seller credit covers your closing costs so that you can keep that money in your pocket, then you can use that money for whatever you want. You could even use that money to create a cushion or boost your emergency fund to cover a couple months of mortgage payments. So it's really, really important right now that you maximize every dollar that you have earned, every dollar in your budget, and every dollar that we have to negotiate with. And our team is really committed to showing you completely transparently a couple different ways that you can do that. So if your lender is not offering you the same, then get a second opinion. We will help you understand the different options and the implications of each, because don't waste a dollar. Not in a time like this, not when the economy is uncertain, not when buying a home has its challenges. Do not waste a dollar. Sandy's back. She's got a success story that we want to share before we wrap this up. Sandy, why aren't you sharing your success story?
I forgot what we talked about.
You're talking about the 2 keys.
Oh, yes. Okay. Okay, awesome. So, okay, thank you. Sorry. So we have a client in contract right now, and when we were submitting their offer, the listing agent was applying pressure because they had additional cash offers coming in any minute. So we already had our offer in. We'd gone over the numbers in depth. Everything looked good. We were asking for a seller credit to do a temporary buy down, and we felt good about it. So the seller starts applying this pressure that, oh, we have additional cash offers coming in, you know. Fun fact, they never materialized. So there was all this pressure to counter and come up with a better offer before there was even any competition. So it's really important to know where you are with your numbers, feel comfortable with them, but then also stand your ground, you know, don't let your negotiating power slip away because someone's pressuring you to do something. And anyway, so the cash offers never came in. The seller did counter and wanted to reduce our seller credit by a certain amount. So, you know, we countered back. The point of the story is that right now there is negotiating room, and like Shivani was talking about, you can squeeze the seller and make sure that you're not wasting any dollars. So advocate for yourself, and know your numbers and feel good about what offer you're putting in, and being able to get a good deal. So they are getting some repairs as well. So it's yeah, it's definitely a win for them, and there's, like, you know, room right now to negotiate.
Awesome story. We want to also tell you about Sandy's and I's class that we're going to be hosting. This one we just hosted last month and it was super successful. We had a lot of people reach out saying, please, can you do another class? So we weren't able to make it. And we're going to be hosting a webinar on December 14th at 12 p.m. And we are not going to send out a recording because, let's be real, you're never going to watch it if we send it out after. So make sure that you save this slot, 12 p.m. December 14th, in your calendar so you can attend. We're going to be going over a lot of different strategies. We're going to be going over things that you really need to know to really level up and become that advisor, and really be able to talk about what your value is that you're bringing in to your clients, and be able to explain to them exactly why you are the best at what you do, and also go over miscellaneous things that you don't think about that you need to know in regards to, like, appraisals, condo miscellaneous things, manufactured miscellaneous things, different types of loan programs. You don't have to be in the industry for very long, or it can be for someone that's been in the industry for years, but you just want to really sharpen your skills. We invite you to attend our class.
And we invite everybody else, if you want to schedule a one-on-one call with us, if you need more personalized guidance, if you have questions on anything we went over very quickly today, we can slow it down, we can dive deeper, and we promise full transparency. So sorry we went a few minutes over today, you guys. Thanks for being here with us live and in person, and go ahead and use that QR code if you need to chat more. We'll see you next month. We'll see you in 2024.